I welcome you all to today's program on taxation of NPO's comparative analysis of provisions of 1961 Act with the 2025 Act. For that, we have our distinguished speakers here, our Ramachandran sir with us. I request you to occupy the dais. So, before we move on, I request the members to stand up for our ICA motto song.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तदेव शुक्रब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्वैता 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 एतद्वैता.
Thank you. So, before we get into the session by our sir, I would like to give a brief summary of our CA Ramachandran sir, which qualified in the year 1987. He has over 3 decades of professional experience. He has addressed numerical national and international conference and also shared his expertise with members across various branches of the Institute of Chartered Accountants of India. He is actively involved in many non-profit organizations as trustee, committee member, etc. And he is also authored 2 books related to trust and institutions, Evolution of Amendments to Provisions of Income Tax relating to Trust and Institutions, Evolution of Amendments to Income Tax Provision for NPOs. And these 2 books have received a wide appreciation from our professional fraternity also. And in addition to his professional achievement, Sir has been actively involved in various social, educational and non-profit organization activities. Sir, on behalf of SIRC, I say we welcome you, sir, to today's program and being with us today. And as a token of appreciation and our gratitude, I would like to invite CA Suresh Kumar, sir, to kindly give over the memento to our speaker. Thank you, sir. I would like to invite CA Ramachandran sir to kindly take over the session. Thank you, sir.
Fellow members of the profession, students, good evening to all of you. I am thankful to SIRC, especially Chairperson Mrs. Revati Raghunathan, for the opportunity given to me to share my thoughts and interact with you on the subject provisions relating to NPOs. During the year 2010, the then Government of India introduced Direct Tax Code. Lot of deliberations went on, but did not see the light of the day. However, the present government had introduced the new income tax bill in the month of February 2025. Lot of thought process went on. Parliamentary Standing Committee was constituted to study the inputs from various stakeholders, including professionals like us. I too had presented some of these suggestion inputs, which I will share it later. Parliamentary Standing Committee went through the various suggestions received from various quarters and presented their recommendations to the Government of India based on the same New Income Tax Act 2025 was enacted in the month of August 2025. The New Income Tax Act has brought in significant reforms to taxation and regulatory framework for NPOs. The New Income Tax Act 2025 introduces a new unified term, registered non-profit organization, in the place of trust and institutions. The provisions relating to NPOs are structured in such a manner from section 330 to 355 under the new Act 2025. Whereas under the Act 1961, provisions relating to NPOs were scattered between 10, 11, 12, 13 80G and 115. In the new Act, proviso and explanations which were incorporated in 1961, they find a place as a separate section in the new Act. Before discussing on the comparative analysis of 1961 Act and with 2025 Act, let us go through the contents, how 1961 provisions incorporated in the 2025 Act. Income Tax Act 1961, 215 has been in the 2025, it is shown 223, section 346. 1023C, 3AB, all those things are find a place as under Schedule 7. Section 11 in various section 333 to 350. Section 12 we'll discuss in detail. And section 13 again in under various section. 80G under 354 and 133. 115 BBC under 337. 115 TD and 352. These are all the sections omitted from the Income Tax Act 1961. 11.1 Explanation 2. This section allows the trust and institution to carry forward unspent income during any particular year and accumulate the same for spending in the subsequent year. When the bill was introduced, this particular provision was omitted. However, the same was reintroduced. Had it not been reintroduced, the NPOs would have been compelled to comply with 11.2 and accumulate for a period of 5 years. 11.1b 11.1b. This is tax implication on non-compliance of 11.1 Explanation 2 provision. When 11.1.2 was reintroduced, the same has been again reintroduced. 11.1a. Reinvestment of consideration on sale of immovable property provisions were removed. However, same has been reintroduced. Had it not been reintroduced, NPOs would have been put to genuine hardship. The sale consideration should have been shown as a regular income, and the same should have been applied towards charitable objects. Some of the institutions which were incorporated constituted long back, they would have purchased the asset several years back, and when they sell, they might be realizing a large sum. Expecting them to apply within 5 years would be a difficult task. Under 11.1a, reinvestment include deposit of capital gains in long-term FD is also considered as application and exempt under section 11.1a. 12AA, this is a provision relating to registration process. After the introduction of 12AB, this is irrelevant. What are all the new sections in 2025? 332.1. These are all talking about application for registration. Who all should apply for registration has been incorporated here. Public trust, society, company, institution, all those things, but all of them has been classified as registered non-profit organization. 332.2 as per new Income Tax Income Tax Act. Any delay in filing application for registration, if not condoned, who is eligible for registration? Concept of irrevocable trust has been brought inside the Act itself. Now, normally these days when you go for registration, all these years, the Income Tax Department asks whether irrevocable clause is there in the one of your trust deed or not. Now, this has been made in the Act itself. If your trust or NPO is not irrevocable, then you will not be able to apply for registration itself. 332.6. is any delay in filing application for registration and if not condoned, tax on accredited income as explained under section 352. This is a new provision. 334, how tax is determined on regular income and specified income is explained, which we'll discuss later. 335, what is regular income has been explained. And 343 is another new section, is a deemed accumulation. Normally 15% of the income is deemed to be applied normally, but here in the new Income Tax Act, what they say, it should be invested as per most specified under section 350 of old 11.5. So earlier deemed to be applied, we don't need to worry. just 11,500, 15 rupees, 15% of it, you don't need to spend anything. Now, even if you don't spend that money, and the deemed application should be invested as per the mode specified. And 355 is the interpretation. It's a new this thing. What are all the important important terms they have explained? What is they define? This is redundant section. We'll just ignore and then we'll go to the. These are a suggestion and inputs which was several people had given in some of the, that is the definition of charitable purpose, 215 and this is 223. There if you go to the definition of charitable purpose, plain reading of 215 and 223, if you read that everyone will be under impression that amendment charitable objects have become very, very simple. But all those provisos what has been given in 215 has been brought under 346 section. Again, 11.1 explanation to retention of carry forward which we have discussed. And 11.1 reinvestment of consideration from sale of immovable property, that also we have discussed. And this is on the clarification and accumulation of income 11.2. This is still department, some of the assessing officers that take a position. If you are going to accumulate the income for a period of 5 years, then say whether it is for revenue or capital, they raise a question. You cannot simply say towards this particular objects. So that still, and that too under NFAC, different officers are taking a different position. So I suggested it should be administrative guidelines should be issued, but so far it has not been given. And simplification of section 345. Next slide I will explain how this was in the bill, how this was changed in the act. Residual income is defined as total income minus regular and specified income, without accompanying any specific explanation whether it should be taxed or not, how this should be done. There is no legal explained on a legal provision stating how it should be treated in practice. And specified violation 332(7). This is a new suggestion there also. What is being stated. When the principal commissioner is empowered to grant or renew registration if satisfied with genuineness of activity. However, there is a provision clause stating if they are not complying with any other law, that is how it should be treated. It's going to $1 billion difficult question. This is as per income tax bill 345. No registered non-profit organization other than a registered non-profit organization carrying out advancement of any other object of general public utility shall carry out commercial activity unless such commercial activity is incidental to attainment of objective. All these things are. This you suggest it should be simplified or sentence should be better. Now it has been a registered non-profit organization other than shall not carry on. That instead of starting with negative, now they brought it positive, this thing. This is a comparison between 215 and 223. If you, as I explained, just 215, all the provisos, what all to be done is there, what all is restriction is there. If you read only 223, it only talks of charitable purpose, relief of the poor, education, yoga, medical relief, preservation environment, monuments, advancement in any other object of general public utility. What are all the restriction on GPU has been explained in 346. Definition. Without reading the 346, definition will become incomplete. Again, definite 215 was a 233. Unless you read 346, definition is incomplete. Advanced GP charitable but subject to 346. Who all should can register charitable specified in receipt 332. Now only those earlier under 12A when we are under 1961 Act, any trust even without registration were able to apply for registration and get the registered under and get the income tax registration. This 1023 3AB and Schedule 6 serial number 17. Under Income Tax 1961 Act, they say institution to be wholly or substantially financed. They have not specified what is the wholly or substantially financed. Under 2021 Act, 25 Act, they say substantial finance is determined by a specific percentage. There also they have not specified what is the percentage. They only specify the percentage. All other things remain the same, only exceeds specific percentage is stated. In fact, they could have very well mentioned more than 50%. That would have solved many of the issues. 3AC versus Schedule 7, serial number 18 also similar substantially financed only. This important 1023 C3AD versus Schedule 7, table number, serial number 19. This revenue limit for exemption, both Income Tax Act 1961 and 2025, they are talking about 5 crores. But here, under the Income Tax Act 2025, this combined exemption, if receipts from either from the education institution or hospital exceed 5 crores, the exemption is lost under 1961 Act. Whereas under 2025 Act, combined receipts from both education institution or either hospital, combined and hospital, only if it exceeds this, that they lose this qualified. So, institution covered under the above are required to obtain Resolution 322 to qualify and comply with all regulatory conditions. Language is simplified. Clarification voluntary contribution is given here. When as per total income makes the explicit. Sorry. This is 11(1)A versus 336, 342, 343. 15% accumulation is no longer free, which I explained earlier. This has 85% application rule is now statutory. Under 1961 Act, 15% can be accumulated without condition, but under 625 Act, this must be invested in specified modes under prescribed under 350. Deemed accumulation of income, a new concept has been defined. Regular income has been defined as income from property, deposit, investment, making the tax base clearer and wider. Under the 1961 Act, property must be held under trust wholly or partly for charitable purpose, whereas under 2025 Act, NPOs must be registered and property must be held under irrevocable trust wholly or partly for charitable purpose. Trusts have now less discretion holding surplus funds without investing in prescribed modes. So, who is eligible for registration? What is regular income? Components of regular income are explained in the new Act. 11(1)C versus 338A, the same fundamental principle. Procedural promotion of international welfare is brought in under both the Act, 2025 and 1961 Act. There is almost similar provision. 11(1)D, that is corpus donation. 11(1)D, 338B, 339, 340 and 355D. Corpus donation is defined under section 339. 338B clearly defines corpus is not regular income. In earlier 1961 Act, corpus donation will be added to under this thing. Then we will say exempt under section 11(1)D. Now this corpus donation need not be brought into the regular income. This thing itself, it can be. 2025 Act prevents corpus for using corpus for unintended purpose, transferring corpus to another trust, parking donations without the corpus donation has to be invested in specified modes. Separate corporate account should be maintained, investment should be tracked. The deeming provision for religious place is there. 338B and a specialized deeming provision has been brought in. Section 340 allows renovation of donations to treat corpus only if strict conditions are met. Earlier that provisions were missing under 1961 Act. Explanation 1 versus 335D. Again, compliance, a voluntary contribution, statutory, regular income has been defined. Income Tax 2025 removes the need for special interpretations for contributions for the 15% limit by incorporating voluntary contribution directly as a regular income. 11.1 versus 341.5 to 8. This was not in the original bill. They brought it in the Act subsequently. The 2025 Act provides explicit subsection 345 to 8 for deemed application of income, improving clarity over 1961, more complex. Standardized deadlines option must be exercised by the due date specified in the section 263(1), whereas under 1961 Act they said that you have to within before due date for filing of the return, their audit report to be done. Now, even though circular provided before the due date, but Act was like that. Now they have made it very clear it should be before the due date for filing of the return. Consistent. So, comparative analysis for 341.5 to 343. 341.5 talks about deemed application, 343 talks about deemed accumulation. Both deal with treatment of income not immediately applied but for different purpose. 341.5 is optional, 343.1 is automatic. Because unless you spend that, unless you invest it, you won't be able to get the benefit. 341 is compliance flexibility, 340 statutory allowance. Deemed accumulation exists even without any resolution or form. Nowadays that 9A will have to file, that is being 341.5 requires explicit declaration. Non-compliance under 343 might affect exemption. (11.1) Explanation 2 versus 341.3c. Narrowed or modernized, same fundamental, both the acts, 61 Act and 2025 agree corpus donation to other organizations do not qualify as application of income for exemption purpose. (11.1) Explanation 3 versus 341.1a. The 2025 clearly defined that only sums which are actually paid during the tax year count as application of income, simplifying compliance and reducing ambiguity. Both acts ensure that only genuine traceable applications of income, charitable as deduction, exemption, but 25 Act does it far great procedural. (11.1) Explanation 3A versus 340. And 25 Act provides a structured standalone section 340 listing the conditions for treating just donations as corpus compared to embedded explanation in 1961 Act. 11.1 Explanation 3B. See 337 table serial number 5. Both acts impose strict accountability on corpus donation. Any breach of condition, misuse, improper investment results in immediate taxation of the affected sum. Both acts clearly specify income arising from violation recognized in the year of violation occurs. 1961 Act lists condition explanation 3 maintaining identifiable corpus using funds for intended purpose only. No donation to other persons. Corpus donation aim to regulate. Both the acts aim to regulate voluntary contribution forming part of the corpus with taxation triggered upon. Just members, do you have any queries at this time? Shall I proceed? Because until now, shall I proceed, sir? Am I clear? Or I am very fast, or I am not am I able to explain properly? Yes, sir? Shall I proceed?
Please, sir.
Huh? (11.1) Explanation 4 was a 341, 1, 2, 3, 4. Treatment of corpus and loan applications. Both acts initially exclude application from corpus or loan or borrowing to treat. 2025 Act clarifies that exact condition 5-year window post 31st March 2021 no violation for recognition providing operational clarity. Both acts limit application of income to 85% of donation to other trusts or institutions. So, summary 2025 retains the substantive principles of 1961 Act regarding application of income from corpus, loan or donation to other non while significantly improving the clarity. 11.1 Explanation 5 versus 341.3b. Both the acts enforce that each year's application of accumulation income is independently asset with no carry forward or offset from earlier years. This right, even 1961 Act was also like that only, but that clarity was not there. Different courts have taken a decision that when there is a excess applications there in a particular year can be offset in the subsequent year. But now the Act is very clear, and then they made that option closed. This 11.1 capital A was 341, which is discussed about the reinvestment of capital gains on sale consideration. Here, but however, an updated reference cost of acquisition capital gains computation reference updated from section 48, 49, 55 of 1961 Act to 72, 73, 70, aligning with new capital gains framework. Non-profit sector or association organization must maintain accurate records or cost, improve net consideration and extent of charitable application to claim capital gains as deemed applied. This is 11.1b. Nothing but that where 11.1.2, when there is a 11.1 explanation 2, where there is non-compliance will lead to tax implication. Both provisions of income 1961 and 2025, if not actually applied, taxes it immediately following year, while 25 Act uses a table specifying the tax year linked to deemed application restriction 341.5. Principle of preventing misuse of tax exempt income remains consistent. This is 11.2 accumulation of income for the period of 5 years versus 342. Both provisions allow non-profit organization to accumulate income for a subject of 5 years. Both acts require the organization for a statement in the prescribed form 10, but now here rules have not yet been specified. 25 Act requires the accumulation step by the due date of return, slightly different 1961 Act. It was two months before the due date for filing of the return. The exclusion applies to 5-year accumulation period. 2025 Act clarifies the accumulation can be done out of regular income. Administrative guidelines may be needed to clarify whether purpose accumulated under section 11.2 or should be treated as revenue or capital. Both provisions aim to allow accumulation for future charitable purpose under defined condition. 2025 Act provides more specific procedural details linking the statement submitted income tax and filing deadline, whereas in 1961 Act simply requires submission during the previous year. Underlying remains consistent. (11.3a) versus 11 and 11.3.1 versus 337 table serial number 6 and 7. Misuse of accumulated income. Both provisions state if accumulated income applied for non-charitable, non-religious purpose, it loses tax exempt status and becomes taxable. 1961 Act does not define the year in which the tax year in which violation occurs. 2025 clearly specifies that income tax in the year it is applied for non-charitable purpose. Both Act aim to penalize the misuse of accumulated income by taxing it when used for non-charitable purpose. 11.3b and 11.3.2 versus 337 table serial number 4. 11.3 non-compliant under 1961 Act. 11.3 non-compliant leads to loss of exempt status, making the income taxable. focuses on whether income stays invested in specified forms. 337, taxability arises from the act of making investment that violates section 350, irrespective of investment form. This results in direct taxation. 11.3 focuses on how accumulated income loses the exemption when not maintained in prescribed form. 337 addresses misuse of funds or improper investment resulting in taxation in the year of non-compliance. (11.3c) as 330 serial number 8. Purpose of accumulated income. 11.3c and 330 address accumulated income that is not used for the purpose for which it was accumulated or set apart. Utilization period refers to the period outlined in 11.2 which specifies time frame within the accumulator must be applied. 2025 Act refers to 342(1) which sets a specific period for non-registered non-profit organization to utilize their accumulated income. 11.3c of 1961 Act and 337 of the 2020 deal with taxability of income accumulated for specific purpose but not utilized within the prescribed period. Tax consequences are triggered when the accumulated income is not used as intended, ensuring non-profit organized trusts accumulate appropriately and within the allowed period. (11.3d), 11.3.4 versus 337 serial number 8. Both 11.3d and 337 deal with taxability of income transferred or credited to other entity. Key difference is 11.3d allows a wide range of eligible recipients, whereas 337 focuses transfer between registered non-profit organizations. Both provisions ensure accumulated income is used appropriately with tax implication for any improper or unintended transfer. 11.3a versus 342 5 and 6. Here both the Act allow flexibility in the application of accumulated income when the other than the originally intended purpose due to organization beyond the control of the organization. Ensure that accumulated funds will be applied to other charitable or religious purpose in conformity to the objects of the trust or NPO. 1961 Act requires the trust or institution to submit an application specifying the alternate purpose. 25 Act requires the registered non-profit organization to submit an application in prescribed form. Both require AOR approval before the alternate application is allowed. Remaining all these things are same. 1961 once approved, 11.3 applies if the new purpose is specified in the original notice under 11.2a. 11.3 capital A first and second proviso versus 342(2) and 7. Restriction on accumulation during application during accumulation. Both the acts prevent premature application of accumulated income to other entities, that is section 11.3d of the Income Tax Act 1961 transfers to other NPOs in 2025 while the income is still invested or set apart. This ensures that the tax exempt status is preserved and the accumulated income used for its intended purpose first. Treatment on dissolution. 1961 Act allows assessing office to approve accumulated income, application of accumulated income for purpose under section 11.3d in the year of dissolution. 2025 Act allows on application in prescribed form or manner to apply accumulated into another NPO in the year of dissolution. Both provisions provide flexibility to safeguard accumulated income if the original organization ceases to exist. Both the acts require assessing officer or approval for transfer either during dissolution or for changes in application to other entities. 1961 Act applies to trust and institution accumulating income under section 11.2. 2025 Act applies to registered non-profit organization including all types of accumulated income. (11.4) versus 344. 1961 Act explicitly provide that any excess income over reported accounts deemed applied to non-charitable purpose triggering tax consequences. 2025 Act, while AO can determine income, the specific consequence of excess income is not outlined, leaving to the general provisions of the Act. Both the Acts give AO the power to determine income from business undertakings held by non-profit organization. 1961 explicitly outlines the consequences for excess income, while 2025 Act does not directly specify this, leaving under general assessment rules. This is 11.4a and 345 GPU. Allows trust and institution. 1961 Act 11.4a allows trust and institutions to carry out business activity only if they are incidental to the organization charitable or religious activities. This provision ensures business income does not affect the tax exempt status as long as the activities are linked to the organization's core purpose. 2025 Act Section 345 also permits registered non-profit organization to carry out commercial activities, but specifically restricts non-profit organization not engaged in public utility activities from conducting commercial activities unless it's incidental to attainment of primary objective. Again, maintain separate books of accounts, all those things almost same as per 1961 Act. It is implied NPOs carrying an activity within the main limbs under T23 can engage in commercial activity provided they are incidental to the attainment of main objective. Reading Section 345 independently makes comprehension difficult. This improves significantly only when you read along with 346, which is 223 and that 340, unless if 341 and 346 to be read together. Both acts aim to ensure non-profit organizations engage in business or commercial activity only when they are incidental to the attainment of main objectives. Income Tax Act 2025 introduces an additional layer of restriction, specifically limiting such activity NPO focused on public utility, making the law more structured. Section 340 ideally be read 340 for proper interpretation, proper compliance. 11.5 versus 350, this is again that investment modes. Income Tax Act 1961 provides an exhaustive fixed list of eligible investment, whereas 2025 Act Section 350 adopts a more flexible approach by referring the investment permit in Schedule 16, which allows the central government to update the list of permissible investment modes by a notification. This enables the system to adapt quickly. So whenever amendment need not be made when it is stated in schedule at any point at time government can bring out the notification. They don't need to say this is not eligible, that is eligible by amending the provisions. Income Tax Act 2025 is designed for better adaptability over time using government notification and an evolving schedule to keep up with changes in the financial environment. Section 350 of the Income Tax Act 2025 provides specific modes of investment and deposit and delegates power of central government to manage Schedule 16. This creates greater flexibility. In contrast, 1961 Act offers a rigid but detailed comprehensive framework. Eleven 341.3a. Well, the Income Tax 11.6 and Income Tax 2025 340 serve the same fundamental purpose of preventing double claims. The Income Tax Act 2025 improves upon the income tax by offering greater clarity, more structural framework. That is that depreciation, mainly is talking about depreciation, where 11.6 also talks about depreciation. 11.7 versus 333.1. Both Section 11.7 and Section 333 income tax aim that non-exempt income registered trust or non-profit is part of the total income computation. However, the Income Tax Act 25 brings clarity and by using schedules and tables to specify exact exemption, improving ease of compliance. This structured approach better suited for a modern regulatory framework. Both provisions aim to include the income of the entity in total unless it is specifically exempt. (11.7.333). Here, both the provisions ensure if a trust or institution becomes eligible for specific exemptions by a notification and approval, its general registration becomes inoperative. In 2025 Act streamlines this by clearly reference to schedules and tables, making it easier to track when registration ceases and preventing ambiguous interpretation. Both the acts ensure that once a sum has been claimed as an application of income in a particular year, it cannot be claimed again in subsequent years, preventing manipulation or abuse. Both 11.7 of the Income Tax Act 333 reflect a consistent policy to regulate registration status and application of income for non-profits. Income Tax Act 2025 introduced structured and schedule-based approach. Now we are section 11. We are going to section 12. Any doubts, sir, so far? Shall I proceed? Section 12.1 versus 335. Corpus donation treatment improved. New Income Tax Act explicitly excludes corporate donation from regular income under section 338B, making the exemption clearer compared to 1961 Act. Foreign application of funds defined under, unlike 1961 Act, 2025 provides specific conditions under which income applied outside India can be excluded from taxable income. The term regular income is defined under section 335. Instead, under old Act, income derived from property held under trust as used in 1961 Act. Exemption provision restructured. Direct reference 11 and 13 from 90 is removed. Instead, similar exemption is provided under 338. 335 of the 2025 Act defines regular income to include voluntary contribution but does not expressly state that corpus donation is excluded from regular income. However, section 338B explicitly excludes corpus donation from regular income. (12.2) versus 337 and its table. Taxation of medical and educational services. Both the Income Tax Act 61 and 2025 include specific misuse conditions prevent misuse of charitable status. While charitable operating medical or educational institutions are generally eligible for tax exemption, this exemption does not extend to services provided to related persons or specific purpose as defined at 13.3 of the Income Tax 1961 and corresponding provision in 2025 Act. Income Tax 2025 retains the definition of related purpose similar to that of 13.3, including the author, founder, trustees, substantial contributors, their relatives, and entities with a substantial interest in the organization. Specified income taxation under 337. A significant improvement in 2025 is clear and structured interpretation of 337 is explicitly defines what is specified income and taxable in the year when an income is applied to benefit of related purpose, taxable in the year such implication occurs. 2025 Act provides clearer guidelines on tax year in which income is applied for the benefit of related purpose is taxable. Both Income Tax 1961 and Income Tax 2025 treat income applied for benefit of related purposes as taxable. However, 2025 Act offers more structured, detailed, and transparent framework with an 12A1 AB to AC was 330 to 3 table. Late application condonation. Income Tax Act 1961 includes a proviso allowing the Principal Commissioner of Income Tax to condone the delay in filing the application where there is reasonable cause. New 25 Act also provides condonation clause in section 332, suggesting a stricter and time-bound approach. New Income Tax 2025 provides explicit clarity about the validity period of registration, typically 3 to 5 years as per the table, making it easier for non-profits to track. In contrast, Income Tax 1961 does not explicitly specify fixed validity period. It focuses more on reapplication under various circumstances. 2025 Act specifically addresses provisional registration with clear timelines for applying permanent registration after commencement of activities. Renewal and reapplication. New 2025 Act provides more detailed procedure for renewal and reapplication. The specific deadline that at least 6 months before the expiry. 1961 Act has provision of reapplication but does not elaborate a specific timelines or structured validity period. Modification objects. Both 1961 and 25 Act require any modification of the trust institution objects that does not conform to the original conditions of registration be reported to Principal Commissioner and Commissioner within 30 days of such adoption or modification. This ensures accountability and proper record. New Act 2025 provides significantly more structured, transparent, predictable framework. 1961 Act provides some flexibility, notably condonation of delay for reasonable cost, but does not provide clear period of registration. 2025 improves compliance discipline but removes some flexibility present in the 1961 Act, making the process stricter and more predictable. Tollia 1 AC Proviso versus 332(4) and 9. Condonation delay mechanism. Both Income Tax 1961 and New Income Tax 2020 allow the Principal Commissioner to condone delays in filing application if there is reasonable cause. Once condoned, the application deemed to have been filed or furnished in time. Specific provision for legacy registration. New Income Tax Act 2025 introduced specific provision 332(9) to handle cases where persons registration rank under 1961 expired before 1st April 2021. The provision clearly allows such entities to apply under new regime upon condonation registration granted for a fixed validity period 5 years from April 2021. 2025 Act provides explicit clarity on the validity period granted under condonation provision, typically 5 years from the start of the year 2021-22. Tollia 1B was 347. Both Income Tax Act 61 and 2025 require non-profit organizations to maintain books of accounts and relevant documents where the total income exceeds prescribed non-taxable threshold. Maintenance of books of accounts is linked to audit and reporting requirements also. Both, that's not, in 1961 and 2025 Act, there is no change in this thing. Tollia 1B2 was 348, audit requirement. Both the Income Tax Act 61 and 2025 mandate an audit by a qualified accountant with the organization's total income exceed prescribed non-taxable threshold. Audit report submission. Both acts stress the importance of submitting audit report that is duly signed and verified by a qualified accountant and prescribed form. Threshold for complaint, both, all these things same. Prescribed date for audit submission. T20 Act refers more generally to a prescribed date, allowing more flexibility and easier regulatory updates, where 61 Act talks about audit report as specified under section 44AB. Tollia 1BA versus 349. Mandatory return filing upon threshold exceeding. Both the Income Tax Act 61 and 2025 require that a return must be filed by non-profit organization when the total income exceeds prescribed non-taxable threshold. Specified time limit for filing. Income Tax Act 1961 refers specifically to time limit prescribed under Section 139, while 2025 Act refers to 263(1) with a general prescribed time limit. Income Tax Act and 61 and 2025 are largely aligned to and require non-profit organizations to file return of income once their total income exceeds non-taxable threshold. New Act provides more flexibility and adaptability in specifying the time limits and procedural requirements. Both acts emphasize the importance of transparency formal income declaration. Totally 2 and its provision 332(3) and its table serial number 1 to 7 column A, B, E. Both the acts align in ensuring 11 and 12 apply for post-registration. 2025 Act adds explicit provisional registration for new non-profits, ensuring immediate recognition and continued tax benefits. Overall, new Act provides more structured and clarity and predictability in registration. 1961 Act applies under now 11 based on general principles. 2020 Act provides consistent certainty through defined validity period. Toll AB 1 AC 332(3) and the table 1 serial 1 to 7. The 1961 Act is more flexible, commissioner discretion in verification and provisional registration. 2025 Act structured with clear timelines, tables and validity period, reducing ambiguity. Both acts allow extending registration to 10 years of income, 10 years if income is less than 5 crores in preceding 2 years, reducing compliance burden. 1961 Act, the 5-year registration standard, provisional for 3 years with discretionary extension. 2025 Act, specific periods and tables specified for different types of application, providing greater clarity and predictability. Both acts empower the commissioner to reject or cancel registration if activities and objects are not genuine and compliant with due process. Toll AB 1AC Proviso versus 332(5). Both acts link extend registration validity to a income-based 5 crore in the preceding 2 years, providing relief to smaller non-profit organizations. The standard registration period of 5 years doubled to 10 years, reducing the frequency of renewal and associate complaints. 1961 Act limited to certain application types. 2025 broader application covering provisional registration, renewals and modification. Toll AB 3 was a 332(10) and 332(3) table number. Both the acts specify clear timelines for passing registration order. 1961 Act specified time limits for regular, provisional and other application 3 months, 6 months to 1 month. 25 Act uses table based approach, mostly 6 months with 1 month for new activities not commenced. Both the acts require the order to be passed in prescribed form and manner. 25 Act offers greater clarity and uniformity. Toll AB 4 or 351 talks about specified violation. Both the acts provide 3 triggers: notice violation, reference to an assessing officer, and selection and risk management strategy. Both the acts require the principal commissioner to verify the acts and facts and provide the trust or NPO a reasonable opportunity to present its case before cancellation. Cancellation applies for the year in which violation occurred and subsequent years. If no violation is confirmed, registration is retained. Both the acts formalize cancellation with the risk-based compliance framework. Told you before, the explanation was 351 specified violation. Both the acts define specified violation as misuse of income or activity in a way that deviates from the charitable non-profit objectives. 1961 Act focuses on whether business income is incidental and properly accounted for, whereas for 2025 Act specifically complies Section 345 and 346, which regarding commercial activity rules. Both the acts prevent income from being used for private religious purpose that do not benefit the public. However, both the acts restrict income application to particular communities or castes, with 2025 explicitly protecting SC, ST, backward classes, women and children. Non-compliance with other laws and submission of false and incomplete application is a violation in both the acts, highlighting the importance of transparency and correct reporting. This will create more problem under 12A before, because some of the trust, even a small PF provident fund, when there is some case is being filed, or FCRA, all this will lead to cancellation of registration under the income tax. Told B5 was 351(3). Both the acts require the orders related to cancellation or refusal of registration based on specific violation be issued within 6 months from the end of the quarter in which notice is first issued. 6-month timeline begins from the issuance of the first notice by the Principal Commissioner. 2025 Act largely mirrors 1961 Act in terms of procedural timing, no significant change in the intent or the scope. TOLAC versus 352(4). Both the Act recognize that merger of charitable and non-profit organizations with similar objects and proper registration may avoid tax consequence. If a merger does not meet condition, 2025 Act explicitly imposes tax on accredited income, ensuring accountability. 1960. Both provisions aim to prevent misuse of tax exemption during organized mergers, while allowing the legitimate merger to proceed without penal consequence. Anything further I think many people have started leaving, probably. Any doubts, sir, so far? Or am I clear in my presentation, or you are not happy with the presentation? Shall I proceed? Yes, sir. 13(1)A versus 351(1)C. Private religious purpose. Both the provision target income used for private religious purpose that do not benefit the public. However, under the Income Tax Act 61, such income is simply excluded from exemption, leading only to taxation of that portion. Whereas under Income Tax Act 2025, such use of income is used as specified violation, which may attract stricter consequence. 1961 Act merely excludes such income from exemption. 2025 classified as violation, opening the door for cancellation of registration, denial of exemption and penalties. (13)(1)B versus 351(1)D. Both 61 Act and 2025 prohibit charitable trusts and NPOs created after the respective laws from applying income for the benefit of a particular community or caste or religion. 1961 Act denies exemption under Section 11 and 12. 2025 Act treats such application of income as specified violation, leading to stronger regulatory actions such as cancellation of registration and taxation under Section 336. Exception for marginalized groups. Both laws cover exception for scheduled caste, scheduled tribes, backward class, women and children. 1961 Act exception by explanation 2 to 13(1)B. 2025 Act explicitly built in 351(1)D. This ensures trusts serving these groups are not considered discriminatory in a negative sense. 1961 Act consequences only loss of exemption, making income taxable under general provision. 2025 Act consequences more severe and improper application is specified violation, leading to loss of registration. 13(1)(c) versus 337 in table serial number 2. Income application for related persons. Both the Act prohibit income or property being applied for the benefit of related persons, trustees, authors, substantial contributors, relatives, and etc. 1960 Act allows some exception where pre-Act trust comply, where 2020 Act provides no such exemption. Pre-Act trust 1961 more flexible. Pre-Act trust enjoy relief where benefit is related to persons arises from mandatory terms. Where 2020 Act applies the same rules to all non-profit organizations irrespective of date of creations. Both provisions ensure income applied in the year for the benefit of related persons taxable in the same year. 1961 Act achieved through denial of exemption. 25 Act achieved by a classification of specified income. (13)(1)(d) versus 350 mode of approved modes of investment. Both provisions restrict charitable trust funds to safe and approved investment. 1961 Act says investment specified under Section 11(5). 2020 Act specified under Section 350, read with Schedule 16, specifies the mode and power to central government to add new ones by notification. 1961 Act allows public sector undertaking shares at certain as one of the approved investment, whereas 2020 Act permits only shares in public sector companies, not public sector. The cut-off dates was uniform rule. 1961 Act had historical cut-off date 1983 to phase out old non-approved investment. 2020 Act removes cut-off distinction and applies a uniform rule prospectively. Only investment schedule 16 are allowed. 1961 Act violation lead to loss of exemption. 2020 Act violation treat as non-compliance which may be considered broader regulatory concept beyond taxation, impacting exemption registration governance. Denial of Section 13(1)(d) denial of exemption funds are not invested in approved investment under Section 11(5), whereas under 350 under Schedule 16 only Schedule 16 investments are valid. Public sector shares, undertaking shares are explicitly allowed. No transitional cut-offs. Again, with regard to investment only, grandfathering of old asset. Both 65 Act and 2020 Act safeguard pre-1973 corpus assets and pre-1983 debentures, preventing unfair and retrospective disqualifications. Bonus shares arising from corpus holding and voluntary contribution are protected under both. Both allow non-approved assets to be held temporarily up to 1 year without penalty, recognizing practical constraints in asset disposal. Both allow retention of business derived assets if separate books of accounts are maintained, ensuring transparency. 1961 Act reliefs carved out as exception for old corpus, bonus shares, old debentures, in-kind contribution, temporary holdings and business profits. Whereas 2020 Act 350 plus Schedule 16, the same reliefs are preserved but structured as explicit permissible investment modes. (13)(2) versus 337 table number serial number 2. 1961 Act prescribes transaction specific list. 2020 Act uses general principle of income diversion. Threshold for diversion. 1961 Act allows 1,000 rupees tolerance. 2020 Act 0 tolerance, no threshold. 1961 gives a detailed scenario: excessive salary, property undervalued, overvalued. 2020 Act broad sweep, no granular listing. 1961 Act explicitly covers investment business where related persons have substantial interest. 2020 Act does not contain this safeguard. 2020 Act principle-based system, stricter compliance focus with no minimum relief but less specific guidance. 337 emphasizes income diversion, applying the same rule regardless of size or form of benefit. (13)(7) versus 337 table serial number 1. Both 61 and 2025 Act tax anonymous donation. Both apply threshold relief of 1 lakh or 5% donation, whichever is higher, and both exempt only and both are exempt only religious. But whereas and for religious institution both are exempt. 1961 Act uses 115 BC as a separate charging section, while Section 13.7 simply denies exemption. Whereas 2025 Act brings it under 337 specified income, making the compliance fair more integrated. 1961 Act exempts only religious trust. For mixed trust, anonymous donation for religious purpose are exempt. 2025 exempts only religious and charitable trust, but adds clarity that anonymous donation directed to education and medical institutions remain taxable. A religious trust or a mixed trust carrying on education institution, only if it is that anonymous donation is granted only for the religious purpose, it is exempt. Whereas if it is granted for religious charitable purpose, it is not exempt, it is taxable. New Act consolidated rules into specified income framework, which may make compliance easier but also subject NPOs to stricter regulator. 1961 Act taxes anonymous donation via 115 BC with exemption for religious institution. 2025 Act taxes them as specified income under Sec 337, keeping the same threshold but providing clear exemption. (13.8) was a 353. 1961 Act simple disqualification rule, exemption denied if commercial receipts exceed threshold. Consequence, income taxable. Whereas the 2025 Act builds a compliance framework under Section 346 and 353. Any breach is considered a specified violation, may trigger taxation, cancellation of registration, penalties. New Act is more structured and enforcement heavy, whereas old law was a straightforward exemption denial. (13.9) was 342(1). 1961 Act is non-compliant accumulation income taxable, whereas 2025 Act non-compliance under Section 342 read with 353 exemption denied accumulated income taxable. Although 340 does not mention taxation, 353 plays the role of 39. Both reason consequence the same, accumulated income taxable if compliance lapses. 1961 Act 39, if a non-profit organization fails to file Form 10 or return on exemption under Section 1112 is forfeited, income becomes taxable. Whereas 2025 Act 342 outlines the accumulation procedure, purpose, declaration, maximum fine, does not directly mention tax consequence. These are picked up by Section 353. (13.10) was a 353(1) ABC. Both frameworks say once exemption is lost, NPO's income is taxable as like a normal SSC, but deduction is still available for genuine and revenue expenditure on objects in India. 1961 gives 4 conditions: no corpus, no loan, no double depreciation, no donations. Income Tax Act 2025 expense 6 condition: it adds must be incurred in India, must be for NPO's object, both of which are implicit earlier. These are 1310 and 353 of Income Tax Act work on the same logic. Loss of exempt does not mean denial or reduction of legitimate application of income. Income Tax Act expands the condition, provide clear. Income Tax Act 2025 expands the conditions. (1310) explanation 353(3)GH. Both provisions ensure that once a trust or NPO loses the exemption, the genuine expenses are allowed and misuse through inflated and non-compliant payments is prevented. 1961 Act directly imposed business disallowance provision, that is cash payments, tedious defaults, excessive payments. 2025 Act achieved the same via cross-reference to general reduction, disallowance section, and making it more systematic. 1961 Act next rigid approach, absolutely no deduction or set-off allowed under any other provisions once exemption is lost. Income Tax Act 2025 is compliance oriented, allows the expenditure only if it passes through prescribed deduction rules. Both framework block misuse, but the old law was harsher and absolute, while the new law is more structured and compliance driven and codified. (1311) 353(4). Both provisions ensure once a trust or NPO loses exemption, no deductions or allowances or set-offs are allowed except for permissible expenditure. This prevents misuse of exemption by claiming unrelated deduction. 1961 Act 1311 absolute prohibition, no deduction, allowance or set-off under any other provisions of the Act. 2025 Act 353(4) restriction is conditional, only expenditure allowed under section 353 can be deducted. 1961 Act implies restriction for after computing income under section 1310. 2025 Act explicitly ties the restriction to approved deduction 353, making clearer when expenditures are allowed. Both maintain the same policy. Once exemption is lost, only limited legitimate expenditure is deductible. (1311) was explanation 2, objective alignment. Both provisions are regulate application of income for the benefit of particular community or caste, which prevent discriminatory use of charitable religious income. However, the trust or institution of SC and ST backward class are exempt from the restriction, ensuring they retain tax exemption. Both laws aim to channel charitable funds for benefit of public benefit and protect marginal groups. The shift 1961 passive protection, 2025 active compliance and enforcement. Both framework allow support for SC, ST backward classes, women and children. 1961 Act retains exemption to protective. 2020 misapplication for other groups is violation, enhancing compliance and regulation cap. ATG is almost similar, there are not much of this thing. The major change in drafting style 1961 ATG Act clustered with different subclasses, whereas 2025 Act seeks to simplify language and presentation while still categorizing donation and 100%, 50% details on first subsections. ATG says in any other no change of benefit, only the wording has been modernized in the 2025 Act. Nearly all the ATG was 133. Nearly all the same national fund trusts are retained. Some obsolete temporary funds like Maharashtra CM's relief fund are being dropped. New inclusions and clarification 22 renovation repair of notified religious places. Earlier approvals and conditions scattered. In 2025 conditions are consolidated. NPOs must be registered under section 354, stricter compliance. Both acts explicitly exclude CSR spent from direction certain funds. Section 133 broadens scope to include minority community development corporation, religious place repairs and other updated clause. ATG 2B was 133 1B. Rationalization of temporary provisions. Old Act 1961 Act specific clauses. Gujarat earthquake relief in 2001, Maharashtra CM relief fund in 1993. New Act draws such expired provisions focusing only on the ongoing nationality relevant institutions. Both acts exclude funds spent under CSR obligations. 25 Act explicitly restates these exclusions in simpler terms. Broader coverage for educational religious institutions still includes universities, blood transfusion council, places of worship. 2025 Act makes eligibility condition based must be charitable, registered, approved instead of listing exhaustive subclasses. New Act aligns better with current welfare priorities, health, environment, clean Ganga, Swachh Bharat technology, welfare, removes outdated or duplicated references. ATG 4 or 133. Both acts restrict eligible donation 10% of the income, so the fundamental rule has not changed. Terminal 20 adjusted gross total income and defines separately. Adjusted gross total income means gross total income as reduced by any portion thereof on which income tax is not payable under any provisions of the Act and by any amount in respect of the assessee entitled to deduction under any other provisions of this chapter. This is defined separately for this particular section. No substantive policy change between new Act and the old Act. Both the acts require funds to be established in India for a charitable purpose, not for the benefit of particular caste, community, or maintain regular accounts and to issue donation certificates. These conditions are now shifted from ATG 5, 1961 to Section 354(1), 133(1)B to 2025. Earlier approval conditions, ATG 5(6) provision was scattered across subsections. 2025 approval has been centralized in 354 with structured timelines, provisional approvals and detailed compliance procedure. Religious expenditure cap, 1961 Act allowed institutions spend up to 5% of the income on religious activities. 225 Act restates this in 354(1)B, ensuring stricter direct compliance framework. Cash donation limit, both Act prohibit donation for deduction. Both Acts prohibit deduction for cash donations above 2,000. No substantive change. Double deduction restriction. Both acts clearly prohibit claiming the same donation under multiple provision, ATG 5A versus 133(1). 1961 Act verbose with multiple provisions and scattered requirements. 2025 consolidate everything under Section 133, deduction rules. Almost same. It's 115 BBC versus 337. (1961) Act applied to multiple categories of institutions, universities, hospitals, funds, trust are under Section 1023(11). 2025 Act simplifies into single category, registered non-profit organization. Both acts, anonymous donations are taxable in the year of receipt or inclusion. 1961 Act clearly fixed the tax rate at the rate of 30%, whereas under 2025 Act 337 does not mention the rate within this section, but it is specified under Section 334. It is wrongly mentioned here. (115 BBC 2) was a 337. Substance retains, drafting style only modified. Terminology shift again from registered trust to NPOs. Threshold consistency, both allow exemption up to 1 lakh or 5% of total donation. 1961 place threshold in subsection 1. 2020 integrate directly into table entry. Carve out preserved, both exclude anonymous donations, specifically towards education, medical aims or religious organization from exemption. They will be taxed. 1961 implement tax in the year of receipt. 2025 Act tax on the year of removes interpretational doubt. (115) BBI or the 334(1). Both provisions impose a flat 30% on specified income charitable or of charitable religious with no policy shift. 1961 Act refers to trust or institution under 1023 C and 11, while 2025 consolidated under the term registered non-profit organization. Both acts allow expenditure, allowances or losses against specified income. 2025 Act shifts from long narrative drafting to short table-driven and modular style, easier compliance and reduced ambiguity. Both acts allow the expenditure and allowances and losses against specified income. 115 BB2 versus 353(4). Substance is same. 1961 Act places the bar inside 115 BBI itself. 2025 Act consolidates the bar in 353 applying to across all NPOs. By cross-referencing permitted deduction 353, policy can no dilution restriction. NPOs are specified income or other taxable NPO, income is taxed on the gross basis without erosion of expenses or loss. (1961 Act is generic text, anything over 15% is not allowed. 2025 Act enumerated contraventions, investment violation, misuse, lapse or diversion. New Act prevents NPOs from parking funds and misusing and diverting them in listing scenario where taxability arises. 1961 Act lacked clear timing rules for 2025 draft gives event-based taxation timing, that is year of misuse, expiry year. 115 BAE excess accumulation of 15% is not allowed taxable. Same principle under 337 but split into detailed contravention buckets with specific taxation years. 115 BBA explanation 3 versus 337. Both provisions target violation of permitted investment norms. 1961 Act linked only to 1023C provision of B and C. 220 Act consolidated under section 350. Timing is made explicit. Compliance with 220 Act the closer loopholes by expanding definition any fund source. (115 BBI explanation D was a 337). 115 BBID, if funds are diverted or benefit for the benefit of related persons under via 1023C or 131C, the income become taxable. 337 Section 337 serial number 2, if any portion of income is applied directly or indirectly for related purpose, it is specified income taxable in that year. (115 BBI explanation E versus 337). Both provisions address misuse of charitable income by applying to outside India without permission. The new bill clearly states tax year in which application is made. Both Act around 1961-25 impose strict 30% tax on unauthorized foreign application. 115 TDA 1 year 354 serial number 4. Substance remain unchanged. Both laws liabilities on the specified purpose and the principal officer and trustee. Due date and refinement. 1961 Act often the end of the previous year or within 14 days after the specified date. 2025 Act ties the due date up to appeal outcomes, not just end of the year. This prevents premature tax payment in pending litigation. (115 TD 1B). 1961 Act is due dates linked to table, sometimes end of tax year. 2025 Act simplified tax due the date of merger within 14 days to the merger, the accredited income. (115) TD1C as a 352(4) and table serial number 9. 1961 Act due date linked to end of 12-month window but worded less directly. 2025 Act expressly state due on expiry of the 12-month period, eliminates ambiguity. 115D long line versus 351. No change in substance. New Act makes it easier to map case specified date, due date. Objective of preventing charitable interest from walking away tax and cut remains the same. Comparative 115 TD2 versus 352(3). Computation unchanged, exclusion streamlined, agriculture income, pre-registration assets. 25 Act uses specified assets, gives flexibility to notify categories via rules rather than statute itself. 2025 Act makes it easier and less ambiguous. 1961 defined in scattered subclause, whereas 2020 centralized in the table. 115 TD3 354 all table. Core principle remains the same. Both laws impose exit tax on accredited income, and a charitable NPO loses its exempt status. Computation is fair market value assets, FMU. Tax formula based drafting. Earlier implicit reference back, structural 1961 Act drafted in dense narrative substance and deeming provisions. 2025 Act 352 reorganized into formula based plus tabular compliance matrix, making it more user friendly. Clearly, 2025 Act clearly differentiates scenario where appeals are filed or not filed and ties due date or appellate outcomes. 1961 Act listed exempt assets directly, the agriculture income, pre-registration assets. 25 leaves it flexible, uses the term specified asset to be defined in rules, gives CBD to power to adjust over time. 115 TD4, no change in substance. 9 notwithstanding clause conversion to ineligible form has been explicit. It has been made in 2025 Act. 2025 Act eliminates ambiguity by specifying both specified date and due date in law itself. In both the acts, once tax on accredited income is paid, it is treated as final, no refund, adjustment set off is possible. Neither the specified person nor any other person can claim credit of this tax. 1961 Act spread across two sections, 115 TD6 and TD7. 2020 merged into 352(5) for simplicity. (1961 Act 115 provides definition like date of conversion, specified date, specified person to be into other section. 2025 Act 352 converts these definitions to practical table linking each triggering event to relevant date and heavy reliance on legal definitions. Scope of coverage, both cover the same scenario: cancellation of registration, modification of objects, failure to apply, merger or dissolution. 2025 Act's presentation with 9 explicit cases removing ambiguity. With 1961 Act explicitly defines eligible institutions. 2025 embeds the idea of specified person within the framework. Core principle interest on delay. Drafting is plain. Are deemed as the 1961 Act and simply state the principal officer, trustee and the specified person shall be deemed assessee in default. 2025 Act 357 makes it explicitly listing both the parties separately: specified person, principal officer and trustee. Drafting style 1961 concise and narrative. 25 Act structured and explicit. 115 TF2 was a 357. Same objective, prevents trust from escaping liability by distributing assets on dissolutions. Expressly excludes tax and interest thereon. Refers only to tax, but since interest separately provided under 356, liability were still enforceable. Common objective, both provisions cap the liability of transfer recipient of assets from a dissolved NPO. Transfer is liable only up to the value of assets received, not beyond their benefit. This is a new 355, the new section. It's like glossary. They mention what is anonymous donation, means any voluntary contribution, refers to in section 249. C, where a person receives such contribution but does not maintain record of the identity indicating the name and address of the person making such contribution or such other particular as prescribed. A lot of institution or trust or non-profit organization are at present, when they collect cash more than 22,000 rupees, okay, ATG is not required for the donor. How the trust can show it as income? Whether it can be shown as a regular income, what is the, what I feel that as long as the donor's identity is proved either by the Aadhaar or any PAN, if they are not giving the PAN, at least they are going to give the Aadhaar number, Aadhaar card, then that will be eligible. At least the trust will not be put to difficulty. Only the donor will not get the ATG exemption, and he has to prove the source later on if the department asks. We don't need to file it in the 10BD. 10BD, when you file for this, we can say these people identities, address we can serve, but cash they will not get the ATG benefit. Approval means any approval under second provision ATG. Cancellation includes withdrawal, and donation means any voluntary contribution registered by a registered non-profit organization from any person. And again, commercial activity means any activity in the nature of trade, commerce or business, or any activity rendering service in relation to any trade, commerce or business for a cess fee, or it's almost that 346 they are defined. Registration includes provisional registration, provisional approval or approval as referred under section 1023C or 12AB of the Income 1961 under section 332, but shall not include approval under second provision to ATG of this ATG, and that is ATG is not considered. Registered non-profit organization means any person having a valid registration under any specific provision, and such registration has not been cancelled. Related person means any of the following persons: author or the founder of the registered non-profit organization, any person whose total contribution to such registered non-profit organization during the relevant tax year exceed 1 lakh, or in aggregate up to the end of the relevant tax year 10 lakh rupees, as the case may be. Just technically, if the auditor is going to donate 1 lakh or 10 lakhs in a year to an organization for which he or she is auditing, will he be prevented from doing the audit? Whether will he be considered as a substantial contributor? Now at least they increased the limit. Earlier it was only 50,000. And the 1961 Act it was only 50,000. There are many auditors I won't say many, at least few of the auditors would have paid some money to the trust wherein they are auditing. Whether you call it as trust which they are adhering to the principles of the trust, they might have donated. Now it's very difficult, 1 lakh or 10 lakhs payment of donation by any trust. Where such author, founder is Hindu and divided family, a member of the family, any trustee or manager, whatever name called of the registered non-profit organization, and any relative of any person referred to in subclass 1, 3 or 4. 1, 3 or 4. And any concern which of the person referred to, any concern which any of the persons referred in subclass 1, 3 or 4 has substantial interest. Relative in relation to individual means spouse of the individual. spouse or the individual, brother or sister, it's almost same definition. Residual income, that as I explained the first, residual income means total income as reduced by regular income and specified income. What is the purpose of definition of residual income is not very clear. Whether they are going to be taxed, what is the importance of this residual income, nowhere I am able to understand. Even I don't want when the rule or subsequent this thing you'll be able to understand. Specified asset means any asset which is established to have been directly acquired by the specified purpose out of the income of the. Okay, all these things are specified assets meaning. Specified person means any person which is registered under any specified provision and any time since incorporation or creation. Specified provision means 12A, 12A, 12AB or income tax under 332. Now under 332 registration. Substantial interest in relation to a person means where the concern is in a company, its shares not being entitled to fixed rate or dividend, whether with or without a further right to participate in profits, carrying not less than 20% voting power at any time during the tax year. In the case of any other person, if such person is entitled and more, these were normally these substantial, all the definitions have been incorporated in the Act itself. Now this is being clearly mentioned separately as a 355 interpretations for easy reference and easy understanding they had given. Otherwise it will be incorporated in the Act itself with whether as normally in 48 to be business this thing, and this is being given separately. So this my presentation almost more than 100 minutes I had given. Anything else from your side? If you have any questions or anything, we can further. I'll be happy to share, reply to your question, and at the same time learn from you also during the process. If anything, you can come and talk here also. Practical difficulties, anything if you have, even under 1961 Act also, it's not necessarily 2025 Act. If any registration, renewal, you have any issues or anything like that, we can discuss together. Not that I know the subject much more than you, but yes, sir.
Delay in application for renewal.
Yes, sir. Yes, sir.
For ATG, what is the?
ATG contain the only prospective, sir. Not condemnation is not provided. It's only prospective they give. The Act is not even now. Even when you go for renewal, they say 10 years renewed for those trusts which are less than 5 crores. 5 crores renewal registration for a period of 10 years. Whereas ATG they give only for 5 years. So 12A and ATG, they have probably ATG, as all of us are aware, that under new regime, either under for the individual assessees or the corporate, when they follow the new taxation at 115BA, they don't want to, ATG slowly they may roll out. They can't directly roll out because that will be totally, that is a problem. That problem is there. Even when you talk about trust, even when filling up 10B form, that cash and non-cash expenditure is a big task. In some of the trusts where they are having more than 100 units, they may be having. In some of the Christian institutions or some of the different this thing, to get all the details, and the statutory auditor will be put a lot of, like whatever may be GST, this thing, same thing. Either we have to simply say that we have received on something like that. It may not be. Anything else, sir? Now have you applied for renewal? Renewal for registration here at present? Yes, please. Huh? You applied for. You got the questionnaire? Amanda, phone.
I got the questionnaire, yes.
Phone. Because that last time that commissioners have given me some instruction what all the requirement for getting the renewal. That's why I am going into that, referring to that this. Now they, if you applied or if you have not applied, if you are waiting for the questionnaire, you have to keep the following documents ready. Original registration under section 12 and 80G. Original. Then financial statements for the last
3 years.
last 2 years specifically, because then only they will understand for them to grant 5 years or 10 years registration.
They have given for 3 years. In my case, they have given for 3 years.
No, at least minimum they want the 25 and 24.
Yes, sir.
Then only they for them to give the whether they'll have to decide whether it is for 5 years or 10 years.
Yeah.
Then if you are receiving grants from government, registration with Durban. If you are receiving grants, foreign contribution registration with FCRA. If schools and colleges are run and respect approval from concerned authorities. And confirm if the mandatory clauses, 6 clauses are there, no?
Yes, sir.
It is in the trust deed.
Yeah, they are asking for undertaking for that.
If not resolution.
They are asking for undertaking, and they will, and also the trust deed copies.
Yeah, and the trust deed, amended trust, originally they were asking for amended trust deed. Originally they want us to record, they register the amendment. Now they, because of huge this thing, they say won't give the resolution, then we'll see.
But if they find that clause is not there in the trust
They will
deed,
not give.
we need to amend the trust deed
Yeah,
and submit.
no, if there is, clauses may not be there. I mean most, I won't say most of this thing, at least last 10 years trust it will be there. 15 years before it may not be there. Now what they want us to pass a resolution and saying this will be amended and then?
No, sir. What they mention in the notice is, if it is not there, they are asked for amended trust deed. It has to be submitted before they give the certificate, renewal certificate.
But no,
they are not mentioned in that way. I mean, in the notice I'm saying.
the notice it is there, but that's what in the notice it is there. But practically what they say, if the resolution, with the resolution they are.
Okay.
Because otherwise they cannot grant registration within that specific period.
Yeah, understood, sir. Correct.
But at least now for the time purpose, you just file the resolution, get the at least before the next, when you go for renewal before 5 years, you may have to do it.
Yeah, sure, sir. But it is stated clearly that you have to give this undertaking, and if the clause is not there in the trust deed, you need to amend the trust deed and submit it before the certification. That's what they mentioned it.
But practically now they are getting the resolution copy with the undertaking that I will register and give it. Because registration also will take longer time for them to. Any other thing, sir? Yeah, please.
The Darpan registration, is it mandatory, sir? Like if I don't get any foreign contribution, I am a small trust, I don't get any foreign
No, that is not it. Only if you are receiving grant from government, Darban registration, and only if you are receiving foreign contribution, those things are required.
So in case while applying for the 12AG or 80G application, I might as well say that I am.
No, you can say that I am not receiving any government, but foreign contribution they may come to know.
Okay.
In the statement.
Okay, fine.
And nowadays some banks are insisting upon I think some of the banks are insisting, even if you don't urban registration, they made it compulsory. Even though the urban registration only for those people who are receiving government grant, now they are insisting upon, every bank is insisting upon urban, if you are saying you are a charitable trust. Even if you don't get 12A, even if you are not obtained registration at 12A, if your name is, I am, then also they are insisting upon urban registration. What's that?
But the amendment, what they are saying is, if any of the clauses mentioned in point number 5 are not present in the trust deed by memorandum of association by bylaws, I hereby undertake to include the same and to file the amended trust deed memorandum of article association bylaws at the earliest. Nothing specific.
That's what. So now they are also there lot of files are there. They cannot say you file, then you may say that will take time. Then they will have to complete within the specified time. Before March they will have to complete. If they are going to wait for that, they may. So at least in our own interest, first get it registered, get it approved, then file it and then get the. Yes, sir. Yes, sir. Sir, mic couldn't. Anonymous donation?
Any change in new act, sir?
No, nothing same. But 61 Act of 2020 doesn't make any change. But here they are very clear, just they are under 355 they are given a definition, that's all. Both remain the same.
That maximum tax slab, the rates, anonymous donation, it's...
Rate and all remain the same, 30%. 30%. See, what is the record? That's why normally if you are going to receive PAN card, then recipient is almost, the donor is very clearly explained. Some of the donors, they do not have PAN card, they don't want to give PAN card, but at least we need Aadhaar. But donor will not get ADG exemption if they don't give PAN card. But at least for us, as an auditor of the trust or institution, non-profit organization, we have to ensure that our trust or institution do not put on hardship, or that will be treated as specified income will be taxed, or it will not be considered as an income. Please.
So what are
What's
the, in case of takeover of another trust? See, I'm running a trust by my own now. I'm planning to take over another trust. So what are to be mindful from my end, sir? What has to be the documentation, or from a compliance perspective, what has to be done from the one who is going to take over the trust? And what sort of documentation should I have to submit to the department with respect to this takeover?
As long as both the
Like
trust
merger-
have told a registration, that is the first condition.
Yes.
Both the trust,
Yeah, that they both are registered, sir. They both are
then no issue at all.
okay.
But otherwise, then naturally with stamp duty will be paid. Stamp duty required to be paid.
So by the
By the person who is acquiring the asset, acquiring the trust rather. If it has immovable property. If it doesn't have immovable property, no issue.
the other trust is having a land, sir. They have about 10 to 20 acres of land, but there's no one to take care of it now. So the trustee who is handling the other trust, so he has saw a prospective trust there, and he is planning to take over it.
Yeah, when you take over, merger or only take over?
They're planning to take it over only, sir.
They take it over in sense what? Because only the trustees are going to be changed, or practically A trust and B trust.
Yes.
A trust is going to take over B trust which has assets.
Yes, correct.
B trust will be run independently as it is, or B will be merged with A.
No, B will be running by its own, like they will be having some 2 or 3 members there. So A will, in the name of A, like the major thing will be A, and the operations will be taken care majorly by A only. So they will only be doing it.
B will remain as a trust independently.
Yes, yes.
Am I correct?
On the paper it will be, B will only be there, but technically
Let
A will only
let us not worry about. Let us not worry about it in sense what I am saying for the purpose of income tax. As long as B as an assessee continues to remain as charitable trust in their own name, we need not worry.
Okay. What if suppose if A wants to take it over completely, sir, take over the operations?
That
as such?
acquire the B trust.
Yes.
Acquire the B trust. Then only acquire the B trust, or as I told you, only that only AC.
Okay.
Merger of both the two entities. Both the entities should have a totally registration, or that is the most important.
Fine.
Then otherwise, no, only stamp duty will be there.
Okay.
Stamp duty accumulation will be there, and maybe we will have to do financial due diligence. As a chartered accountant, we may have to do financial due diligence of the particular trust, whether what are all the other complications, non-compliance are there. Yesterday, on behalf of SIRC, I attended a group seminar, group discussion with the Office of Director General of Audit, expecting our comments on audit report for enhancing ease of doing business for income tax payers in India. We were discussing at that time. Then they issued some questionnaire to us in the committee. Then I asked them to send it to the. We at least 10 or 5 of us cannot give any proper this thing. It should be sent to us, so that we will collect the response from all our members and give it to us. That's it. We will have to give it. Yes, sir. Yes, sir. No, the 343, the new section, earlier, just for 1961 Act, 11(1)A, 15% deemed to have been applied. So, what we normally used to do, 100 minus 15, 85, whatever spent. The 15, what we were, ultimately nowadays, in the last few years I have returned, they are asking when you have the excess spent, how did you meet out the excess spent? It is only out of the loan amount or corpus donation or this kind of 15% of accumulated or deemed. Now they say it should be deemed accumulated. Deemed application is main provision. It was missing in the original bill. Now they brought the deemed application as they brought in. At the same time they say the deemed application, unless it is invested under specified modes under section 350, it will be taxed. So it is no longer under what we normally, if you spend only 85 rupees, it's fine. Now they say 85 rupees if you spend, but at least 15 rupees go and invest somewhere.
So when can that 15% be utilized in future?
If utilized is fine. 100 rupees, 15 rupees deemed this thing, but you are spending 105 rupees means you are spending out of that.
Only once you have an excess of that, you cannot use that funds for your other
Yes, sir. If 100 rupees, okay, 100 rupees, 15 rupees is the deemed application, 85 rupees. If you are spending 85 rupees, is fine. But 15 rupees which you have not spent, deemed to have been applied, it is no longer tax free and no longer exempt unless you invest in this specified mode under section 350. So no longer the money is, you cannot hold it. Either you apply it to a charitable purpose or you go and invest in the specified modes.
Sir, what will be the timeline for that, sir? Because it has to be invested before 31st March of the financial year, or is it like when we file the form?
It should be. It cannot be. Naturally, only after you finalize the accounts, only you know that you have not spent 85%. It should be within that due date for filing of the return.
Okay, but what happens if it is already spent in the next financial year? See, it's the bank account will be the running.
That will be out of the next year current. That will be out of the next year regular income. If you are already spent, means that income last year and we have spent only 80 rupees, 15 rupees you have not spent. Next year, whatever you have spent, it should be considered as from that year income.
Oh,
Sir, in this case, just one small query.
Yeah.
15% is to be invested in specified. So that has to be done somewhere in September or October.
Yeah.
Of the previous year, right? Before that, during the current year, from April to September, if I've already crossed my 100 income of this year.
So it is like this only, sir. Capital gains, when you say you have to invest in a particular within, it's almost like they say it should be invested. So to be on all these things, still what are all the repercussions, complications, implications will come, no one knows. We are only discussing on the plain provisions. Whether it's a valid question what you are raising, or whether if I am going to spend in my thinking or my this thing is, next year that will become whatever spend, unless you are going to finally next year income only will come to know whether you are going to spend more than 100 or not. So before September you invest that, again money has no color. So whatever 15 rupees you just, this FD is that money, we can say, that's all. Corpus fund also they say it should be separately maintained, separate FD. Who is going to maintain separate FD for the corpus? My corpus is even 11.2. 11.2, when you say that when you are accumulating for a period of 5 years, they say you have to earmark that funds in a bank account. But no one is going to take exactly that 500 rupees or 5 crores rupees, 5 lakhs rupees exactly. It might be in the FD for several years. So, but your department also, if they are going to say current year you have accumulated, this accumulation is not, you have not deposited money, this accumulation is for this amount is invested long back. Department also, if they are going to strictly follow this thing, many of us will be in trouble. Many of the assessors will be in trouble.
Sir, even for 11.2 there is specified investments?
11.2 already is specified there, no sir. If you don't, if you are accumulating, it is there even under old law.
No one was doing it, so now it will be, that is what.
Like under old law, only the 15% new concept. Otherwise 11.1 explanation 2, that 1 year there is no, you don't need to, 1 year if you are accumulating, you don't need to invest in the specified modes. 11.2, when you are accumulating for a period of 5 years, it should be in a specified mode. That is 11.5, those days is 11.5.
Then it will, sir, if it is in that case, like if I can go up to September and invest that 15% which is not spent in the previous financial year, then it will be like mere transferring some amount, I mean like that 15 rupees from bank to FD and closing the FD on 1st October. Then it's just like a mere
I fully agree, but at least there, as per theory, law says if you don't spend within that, the 15% should be deemed applicable. If you are going, then it should be invested in specified modes. Practical difficulties, then only, as I told, proviso and explanations and all are removed. Then subsequently, in proviso and explanation will be added and all this. So being that the 2025 Act, all very carefully, the provision and explanation have been brought in a separate section. Almost this, the 61 Act, 2025 Act, broadly the same principles are being followed. Maybe as normally they serve old wine in a new bottle, that's all, nothing else broadly. Otherwise, some of the practical that procedure they have brought in very effectively. How they are going to implement, we do not know. Anything else? You are the only person right from beginning sitting. You don't have any question? Madam, did you were able to, or I was able to explain to you properly the provisions? Sorry, trustee. Yeah.
Trustees, because they are all part of it, if they pay the salary, is there any implication in new bill, sir?
No, the same. As long as reasonable, we have to confirm that it is reasonable. That's all.
Okay. That can be treated as the spend for 85.
Yeah. It is not. It's the same. Under there is. They have not disturbed that provision. So as long as we and I do not know what new audit report is going to come. All those things. There in the earlier 10B, we will have to say that remunerations paid to trustees or trustees have been given such a benefit that are reasonable. Like 42B, when we say that in our business, this thing, we will have to say reasonable.
Taken as application.
Payment to trustee.
Payment to trustee, because the fund comes from the government for the entire program, and the trust has only limited number of people, and only few people can be sourced who have knowledge towards this kind of working. So the entire program is given based on the fact that the trustee has some knowledge in the entire working. So the trustee is the director in this entire operation. So the trustee drawing an amount from the government under the program, is it a valid amount? Can it be deemed as application in the accounts of the trust?
It can be. That's what I say. As long as we are getting funds from the government for carrying out a charitable objects as defined as per our as in objective of the trust. Then for that you are engaging many people. For example, say you are not your particular trustee is experienced in that, you can pay. Okay, for example, okay, how it, again reasonableness only. Again reasonableness, giving payment to payment of remuneration trustee is allowed. It is not prohibited as long it is within the reasonableness according to the auditor. Maybe tomorrow when you file the accounts, okay, you may say it is reasonable. If you are going to get government contribution for 1 lakh, and if you are going to pay 50,000 to the trustee, then it will become unreasonable. Yeah, they may say remuneration clause, but they may not say it is to trustee or non-trustee. They may say remuneration. The remuneration, they would, as Sir put it, remuneration, government would have said, I am giving 100 rupees. The remuneration could be 40 rupees or 50 rupees or 30 rupees. First, it should be within the 30 or 40 rupees as per government government contract, whatever it is. Within the 30 rupees, if you are going to pay entire 30 rupees to the trustee, then it may look very odd. It may not be department, if they are going to take it up, and then they may question it. And your audit report also should say that it is reasonable.
Sir, one more clarification is, if the trust is running short of funds, this particular trust that I'm talking about, they get contributions on one part of the year. They run couple of programs on a yearly basis. They run a lot of programs for the benefit of poor people. So in case of shortfall of funds, the trustee ends up putting from funds from their pocket. Sometimes under the assumption that maybe later they can take the money back, but there has been an accumulation and the money has built up in a few lakhs now. So the question is, how is it deemed? From whatever I have heard from the peers, is that this kind of a loan or amount given by the trustee is not looked into as a good thing in the balance sheet by the income tax department?
No, here, if I understand correctly, just you tell me, the trustee has given some loan to the trust for carrying out the programs.
Yes.
Am I correct?
Yes. So towards some expenditure.
Whatever, carrying out the program, let us not go into detail. Trustee has given some money to the trust for carrying out certain programs. And now, or even last 3 years back, under our own 11.7 itself, it has been brought in. Application out of loan is not, it will not be considered as application.
It will not be considered as
application. Only repaid, that's what I mean. First, at initial, first I am saying, first if you are getting grant or advance from the trustees 100 rupees, if you are going to spend 70 rupees, then that 100 rupees or 120 rupees, let us say 120 rupees, the 100 rupees will not be considered as an application. And later on when you repay to the trustee, then it will be considered an application. Yeah, then time period also restricted to 5 years. Within 5 years you have to repay the loan. Otherwise you will not get that benefit.
But if the trustee is willing to convert it as a donation, then it
Yeah,
can
that is fine.
Then it can be considered.
But the conversion are better if you maybe when a trust is not in a position to repay, then again they will not get that benefit of once they lose that application initially. Then they will not get, just because I have transferred it as in my books as donation, it will not get you will not get any benefit. Because donation is that particular year. Unless they receive it is not a current year income. Donation. Anything else, sir? Yeah. So please.
Sir, in case where a family member of a trustee is contributing.
No. They are all, they will be considered as a donation.
Related party, it will be treated, no, sir?
No. When I'm today, one of the trustees, family members contribute, we consider as a donation only.
Okay. So we we should not be disclosing it as amount received
No,
from related.
can you,
So would that not be considered as amount received from the related party? Will that will
no,
that
no, no,
not be
unless, that's what
calculation?
when the relative, this thing which a substantial contributor, if is going to give more than a lakh of rupees or 10 lakhs in a particular year, then they will be considered as a substantial contributor, and you should not get any benefit out of that. Anyone can give 10 lakhs or 1 crore as the case may be, but he should not get any benefit from the trust, even remuneration.
Okay.
If he is going to get any remuneration, that will be considered as a this thing.
So even in case of substantial contribution, he will not be treated as any non-compliance because he is not. I am not giving any benefit.
Yeah. It's only a substantial contribution, a relative definition is given only for those people who are getting it. As I told you in the initial, if an auditor is going to give donation for 1 lakh or 10 lakhs, then if he is going to do the audit of the same institution, whether he will be allowed to do or whether he is authorized to do or whether he is prevented from doing it, it's so far no question is being asked because no, sir, if substantial contribution, if I am going to contribute 10 lakhs and then I am going to do the audit, whether I am getting benefit from the trust or not. No, there, this is different. Here is where when I am going to underfall that there is under 353 or even under 13 also 115, there is a prohibition to be taxed. Any benefit to a substantial contributor. Here what madam said is with regard to trustee. Trustee is not making any substantial contribution to the, in terms of money. The trustee might be doing the human service to the society, trust or society, but he is not getting any benefit or he is not making any substantial contribution to the, even trustee, here also in the 355 when he learns, even trustee also when he is making substantial contribution like that 1 lakh or 10 lakhs, he will also fall under that. He will also fall under a particular category. No material benefit should go to them.
So in case of cash donation more than 2 lakhs, say
2000.
No, in case of I am donating, say for instance, I am donating 3 lakhs to a trust.
Cash donation.
Cash donation. So would that be any problem for trust?
Yeah, the trust.
Under 269.
No, I'm telling you, this thing. The trust, you should give, as long as you are going to give the name, Aadhaar or whatever it is, I as a trust do not have any problem. Okay, I am able to prove the genuineness of the donor. Identity of the donor is proved. For me, trust is fine. But in your case, tomorrow, certainly when the question will be asked to the donor, you say you have contributed 2 lakhs to the ABC trust.
Sir, how will that be known to
I will be reporting.
I'm not going to claim it, right?
I will be reporting in the 10BD form, no?
If I don't file 10BD, because I don't file 10BD and
trust, you say trust do not file.
Yes, trust
but what will you show that as income? It has come into the trust.
Okay.
It has come into the trust.
Okay. Yes.
At least during the time of assessment, then they will say they will compare with 10BD.
Okay.
Donation received is 1 crore. 10BD has shown only 85 lakhs. What happened to balance 15 lakhs?
Okay.
During the course of assessment they will ask, or if not during the assessment, at least during the renewal time they will ask.
Okay.
10BD. Yeah, 10BD. Unless you are going to 10BD, if you are going to say that is for the payments. Well, one donation received also if you are giving. So naturally then it is not reflected in 10BD. It is not, you are saying it cash donation. Then in that case, overall, I will have to say no. I cannot simply say that cash donation identity of the donor. If I have to give the identity of the donor, other I will have to account it as some other income. Just I am explaining. Then in that case, GST will come.
Yes.
I should have raised some invoice on the. If your trustee is going to raise some any individual, then there should be some sort of invoice between business relationship between the asset trust and the person who has contributed.
So non-filing of 10BD, would it attract any problems, sir?
Non-filing of 10BD, yes, it attracts fine.
Say for instance a trust received 1 crore, they missed up to say 10 lakhs, they missed to file 10BD.
Sorry, I didn't get you.
No, say for instance a trust has received 1 crore as the total income, that's what they've shown it. Out of which they have only filed 10BD for 90 lakhs. they have missed to file 10 lakhs for 10 lakhs. So would that be any problem, sir, here?
Yeah, because the misreporting it will come, no?
No, they have the details of everything, but inadvertently they have not filed.
Correct.
So would,
Sir, then you let there is a provision for rectification 10BD.
but I have not filed it at all, sir. So only if I file it, there will be a
10BD even for 90 you have not filed.
No, for 90 I have filed.
Yes.
For 10, balance 10 I have not filed.
Yeah, that's what. In your financial statements, you are saying 100 rupees I have received
Yes.
as donation.
Yes.
But 10BD which you have filed states only 90 rupees.
Yes.
So with that 10 rupees you may have to answer. You may be called for an explanation by the department.
Okay. So although I have the details of or the list of the person who have donated it, so inadvertently I have
At the
missed it.
time, then we
So I
can say
just
that,
show them.
yeah, donor identity is proved.
Yes.
Only thing it's a misreporting or by mistake, then no issue.
So then the department will not come back.
Yeah, I am by non-filing that donor name in Form 10BD, only donor is put to difficulty. He is not getting that whatever
Benefit.
then date EG or whatever it is. As long in our case, whether you file 10BD or not, in your income tax expenditure account, receipt side or income side, donation is 1 crore, 90 lakhs is 10BD. Or then only at the time of course, we cannot take a stand because while filing when you are finalizing statement and filing the return, naturally you have to see whether 10BD is filed. Because like whether when you are comparing GST with GST return,
Yes.
10BD has to be compared while filing the return.
Oh.
When there is some difference, then you can file the revised 10BD.
Okay. Fine.
While filing, even after filing the return, if you say that I missed it, then it will not be proper.
Okay. Fine. Thank you.
We have a trust which runs an educational institution. So they have to take the NAC rating is given to it.
Yeah.
Now for NAC, they give specific points for what you call certain sort of activities which will be treated as a commercial in general sense. Like they have to do startups for students, or they have to get income from consultancy. So in that case, this income of consultancy and startup will be treated as a commercial activity or activity.
No, the 11.4a, that incidental attainment main object. See, as all of us are aware, relief of the poor, education and health will be considered as a main limbs. So there many business activity or commercial activity is incidental to that, there is no issue. Only when you follow GPU, when you carry on GPU, only all these other issues will come. Then only the restriction, whether it is within that 20%, all those things will come. And you'll have to maintain separate books of accounts and all those things. Yeah, please listen to them.
That probably had to be done. The trust had an activity during the last year. The activity has started and it has got ended in that particular year. But that activity necessitated a change in the object clause. The object clause was not amended because we were also not aware. Only when the accounts came, we came to know that the object clause had to be amended. Activity has got over now, which now does not necessitate a change in object clause. And the trust is now due for renewal. From what I know about the provisions is whenever you have a change or whenever the object clause has to be amended, it has to be from the commissioner's side.
Within 30 days or amendment, modification, 11.7 old this thing and
Exactly,
it should be
sir.
done.
Now the question is twofold. One is I am coming for renewal. So the first question is why you have not amended the clause before. But at the current position, the activity that necessitated the object clause is no longer there. Now, the activity which necessitated the object clause is no longer being done by the trust.
Now,
Yes, now, in this financial year. Now, should I really go for a representation to the commissioner to ratify the activity?
practically if you ask, you just ignore.
That is what we have done now, sir, but
Because, to be honest, all of us are aware when you go, the only circle we are going is exemption circle. Otherwise, we don't go anywhere else. All of them, we are NFAC, we get everything online. At least each one of us, at least 100, 200, when you are filing, they have to handle so many cases in this thing. They don't. That's why even the amendment about one of our friend asked, originally they are supposed to ask for amended trust deed. If they are going to wait for amended trust deed, they cannot grant renewal. Because they will have to grant within 3 months from the date of, 6 months from the date of filing.
Notice.
They won't have time. Then only that's why now we also read that from this thing, one declaration. Maybe if you are very smart enough, we can say next 5 years I can wait and then wait. Yeah. Earliest is for me to next, when you go for next renewal. But in your case, just forget it. Because otherwise it will be put a lot of...
Correct, sir, but just to know on a future...
No, understood. No, I'm just saying, one more
not
practical
in the current
situation, complete.
Yeah, not in the current situation. Suppose going forth, you encounter a situation like this where they have done something which needed an object modification before they commence the activity, but they have already finished the activity. Before the accounts reach you, you know the activity is done, but the object was not modified within the period. Should we go for ratification with the commissioner? And practically, is it accepted by the commissioner when you go for a ratification?
No, normally, as per this thing, there is no provision for condemnation.
Okay.
Here, for this particular provision, there is no provision for condemnation.
Okay.
So, normal this thing, first, before we, normal provision I am talking about, before we intend doing this particular amendment or modification, first you will have to apply to the commissioner seeking his approval. Invariably, the only thing they will find, they will look into whether it is correlated, directly different objection they may object. Okay, one or two, if you are doing some educational activity, and if you are planning to do preservation of monument or trusting, yes, that is also possible. Not that they cannot do. As long within that 215 or C100, this thing they will do. Then once they get the approval only, then you will have to amend the trust. Then you cannot amend the trust deed. First, you can only say, I intend to modify the objects, kindly seek your approval. Then once he gets it, then you will have to modify the... But within 30 days of modification object registration of the amended trust deed, we will have to again submit to the commissioner for final approval. Then only modification objects come to finality. Okay. Anything else? Regarding, since practical, this is one more like this. Nowhere in the act they say before I sell the property, I should get the commissioner approval. Nowhere in the law. Nowhere in the law says if a trust before selling the immovable property, they are allowed to get the commissioner's approval. Unfortunately, one of the assessee, they have been advised by their auditor to get the approval from the commissioner. That trust had almost 7 crores of tax demand. So they have been made to pay 7 crores of tax. Then only they have been issued that no objection. No objection, not at all necessary. Nowhere in the act it is stated. But somewhere someone take this thing, and then subsequent commissioner came. Then I was talking to you, sir, என்கிட்ட வந்தீங்கன்னா நான் கட்டாயம் டேக்ஸ் வாங்காமல் கொடுக்க முடியாது. வராமல் இருந்தீங்கன்னா நீங்கள் பாட்டுக்கு போயிருக்கலாம். Anything else, sir? Shall we close? Thank you for the patient hearing. I don't know how much I was able to satisfy your expectations. Thank you. Thank you very much.
Thank you, sir, for this enriching session. So before we wind up, I have a small announcement. The Audit and Assurance Standards Board of ICAI has issued this exposure draft for SA 600 using the work of another audit. So the ICAI invites various valuable comments and suggestions So kindly fill up the Google form. We have also put it up on the outside. So request you to participate in the Google form and support Auditing Standards Board. Then the other announcement which we require to make is so Chartered Accountant Benevolent Fund. So this is a fund for the CA and by the CA. As you are aware, persons who are not CAs cannot contribute this fund. So as the members who are supporting the other members, we request you to participate in the benevolent fund support for our CA fraternity. So we have, for the past years, we have helped like more than 1,500 families and 2,000 crores in aid. So I also members to support for ICI using the CABF fund. So kindly look into it. The QR link and payment link is also available in the SIRC website. So thank you all for this wonderful session.